So the first one is straight line depreciation, and like the name indicates, straight line depreciation apportions the cost of an asset in a straight line. So with straight line depreciation, the cost is the same each year. The only time this is different will be in the initial purchase and disposal year, where you have made the purchase or sold the asset somewhere in the middle. Then you only account for the amount of depreciation you have used for part of the year. This is the only exception, otherwise, like the name indicates, the amount of depreciation remains the same each and every month. Reducing balance is different. Reducing balance depreciation decreases as the life of the asset increases. It's most commonly used for, say, IT equipment and motor vehicles, where the amount of deterioration occurs in the first couple of years and there's not as much deterioration at the end. Say you hold a motor vehicle for 5 years, the difference in your resale value in year 4 and 5, there's not a lot of difference compared to year 0 and year 1. So how this method works, it does this by using a rate of depreciation that is applied to the carrying amount each year, and this is a really important part to remember. As the carrying amount gets lower, so does your depreciation. And your carrying amount is basically your original cost less your depreciation for the year, and then that's your carrying amount, and then the following year is your ending carrying amount from the previous year, and then you take off your depreciation and so forth. Units of use is used by estimating the number of hours of use of an asset, and then whatever the proportion that you use in terms of hours of use, that becomes your depreciation for the year. It has very limited application and is mostly used in equipment and machinery, where, for example, you estimate you're going to have 10,000 machine hours, and then you can work out your depreciation from that. Unlike straight line reducing balance depreciation, it is not an acceptable method of depreciation used by the ATO. Sum of digits depreciation is rarely used, but is important to know what it is and how to calculate it. To calculate sum of digits depreciation can be messy, as it is the proportion of the unused life of the asset to the total number of years in the life of the asset multiplied by the depreciable amount, basically the asset cost less its scrap value. This proportion changes over time as the asset gets more use and more advanced in years. It is also, like units of use, not used in ATO calculations for depreciation. But it is still important to know what it is and be able to explain it. So that is a brief overview of the 4 methods of depreciation. How they're calculated is different, and different asset types will be used for different types of depreciation. Buildings, for example, will often use straight line depreciation because there isn't much difference in the deterioration of a building between year 1 and year 20. However, reducing balance wouldn't be appropriate. That would be more likely used for, say, a motor vehicle or a computer or any sort of IT equipment and that sort of thing. So when choosing a method, you have to consider, does it accurately reflect the use and deterioration of your asset?